There was going to be a massive attack. It was going to be an attack that would have been by far the biggest attack since World War II. But they've asked us not to do it. They said, please don't do it. And their neighbors said that too. And so we're just going to see whether or not we can make a deal.
President Trump says new talks with Iran will begin on Monday after calling off a planned attack on the country, citing appeals from U.S. allies in the Middle East, including Saudi Arabia. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Oil tumbles while treasuries and gold advance after President Trump raises hopes that the Strait of Hormuz will reopen soon. Goldman Sachs Commodities Research Chief Samantha Dart will be joining us on the outlook for oil, LNG, and of course iron ore as it sinks to the lowest level in a year. The yen rallies after Washington and Tokyo signal readiness for more coordinated intervention, raising the stakes for traders betting against Japan's currency. A stronger yen clouds Japanese exporters' outlook. We speak exclusively with Daiichi Sankyo's CEO after the company upped its revenue guidance, citing favorable exchange rates as one reason. And with energy disruptions reigniting inflation concerns, Prudential Chairman Douglas Flint will be joining us on vulnerable markets for his business and whether mainland China and Hong Kong are insulated. Our top story, the U.S. and Iran step back from the brink of a major escalation after President Trump calls off a planned attack that he said would have been the biggest since World War II. Oil prices are slumping while gold sees gains after Trump also says a fresh round of peace talks will start on Monday. He even suggests that a deal on reopening the Strait of Hormuz may be close.
What we're doing is we're talking to them in the form of a negotiation. It begins tomorrow afternoon, and we'll see if it's true. I'd love to do that, save a lot of lives, save a lot of unnecessary power, to be honest with you. It would take many, many years to ever build it back. If it could, I don't think it would be even buildable back. So we had an attack that would be the biggest attack since World War II.
For more, Bloomberg's Middle East correspondent Aber Abu Omar joins us now from Dubai. And Aber, we've been here many times before.
Yeah, good morning, Haslinda. Indeed, that is essentially, in a nutshell, where the situation is. We went yesterday from President Trump threatening the biggest hit since World War II to then saying that negotiations with Iran are going to recommence on Monday afternoon. And so, as you said, we've been here multiple times before. The markets have been here multiple times before, but you're still seeing oil prices really reacting to these geopolitical headlines from President Trump and Iran. So where do you think things stand now in the Middle East after those remarks from President Trump? Well, we're expecting those negotiations to recommence. We don't have a confirmation from the Iranian side. We don't have a location for those negotiations. Now, based on history, we know that those have happened in places like Qatar, in Pakistan. And so we await to hear more from the mediators on whether they're going to be involved. But again, not a lot of clarity. That has been the name of the game, really, Haslinda, over the past 4 months or so. Not a lot of clarity on what exactly is going to be discussed in those meetings. Now, we have spoken multiple times about the 14 concessions in the temporary ceasefire. Those have gone out of the window with the escalations in the Middle East restarting. The nuclear component, which was front and center, is now taking a backseat to the Strait of Hormuz. That is where everyone, or what everyone, wants to talk about, reopening the Strait of Hormuz to get those tankers moving a little bit more comfort through the waterway. Now, the Iranian Foreign Minister Abbas Araghchi did say through a telegram that negotiations with Oman are at a stage that is towards its final stages. Essentially, he did say, however, and I thought this was interesting. He said that the talks do not cover whether the strait will be open or closed. So yet another layer of confusion about what exactly is being discussed about the Strait of Hormuz. But what we understand, and from our reporting earlier, is that Oman and Iran are talking about a mechanism to open a middle passageway or path in the Strait of Hormuz to get ships moving through this middle passageway between Oman and Iran. Previously, Haslinda, of course, Iran was only allowing ships to move in the pathway that is closest to its borders, so the northern part of the Strait of Hormuz. So this changes the game a little bit, but we await to hear more about the details about these negotiations, and key to all of this is, of course, the Iranian response.
And are there not a lot of clarity on the deal itself? Is there a middle ground? What are we looking at possibly?
I think key to all of this, and the most important thing from both the United States and the Iranian side, is really opening the Strait of Hormuz. The other concessions, the oil sanctions, for example, that were waived and then reinstated, the blocked assets for Iran, and then we're also talking about the thing that the United States had gone into Iran at the beginning was the nuclear component. Those will probably be discussed at a later stage. For the time being, the most important element for both the U.S. and Iran remains the Strait of Hormuz. Haslinda, we've reported that the Strait of Hormuz has seen some movement towards the end of last week. We reported, for example, a Qatar LNG ship that was able to make its way through the Strait of Hormuz after idling around it for about 3 weeks. But again, this is a fraction of movement compared to the type of movement that we would see before the war. And then during those couple of days or weeks of calmness after the MOU was signed, and then we saw a little bit of a paralyzed movement in the Strait of Hormuz. This obviously all has these trickle-down effects, not only on the global economy and what we've reported on multiple times when it comes to Brent crude prices and other energy prices, but also with the looming midterm elections for President Trump in the United States. November is really around the corner, and getting a handle on those elevated prices is going to be key for him. And so for both Iran and the United States, for Iran as well to be able to make its shipments cross the waterway without the threat of the U.S. naval blockade, that is also going to be key. And that is the discussion they've been having with their ally Oman over the past couple of weeks or so. And so this is what we're going to be looking at. This is definitely what markets are going to be looking at. And this was the preliminary reaction to President Trump's remarks. You saw Brent crude prices dropping massively at the open. They're slightly down as of now, or it's a big drop compared to what we've been seeing over the past couple of weeks or so. So again, in a nutshell, what we're going to be looking at are any key discussions about an immediate reopening to the Strait of Hormuz.
Aber, thank you. Our Middle East correspondent, Aber Abu Umar in Dubai. Let's get perspective with Samantha Dart, co-head of Global Commodities Research at Goldman Sachs. Good to have you with us. We're not just talking about one crisis, not even talking about two, but three crises all happening at the same time. Hormuz, Red Sea, Black Sea. This is pretty much unprecedented. Could you put that in perspective for us?
Yeah, I think especially on the oil side, on the natural gas side, when Russia curtailed its supplies to Europe back in 22, it was a slightly larger impact. But on the oil side, you're absolutely right. This is unprecedented. And it really reminds us that even though we're so used to thinking of commodities as these global markets, your supply side can be incredibly geographically concentrated. And when you have certain passageways that can be blocked, it makes this even more vulnerable to any instances of, let's say, using that concentration as leverage. So Iran seems very willing to use the strait as leverage now, and I think this is the biggest thing. So geopolitics aside, we see the headlines causing volatility, yes, but for example, on our side, what we're really paying attention to is the volumes, how much is crossing, how much has stopped, and so on.
And what are you anticipating in the coming weeks, next 3, 4, 5 weeks, in terms of fuel supplies, in terms of flows, trade flows even?
Yeah, so what we saw in terms of the ramp up of oil flows after the MOU had been announced was pretty extraordinary. We saw flows in the Strait, well, not just in the Strait, to be fair. If you take into account the Strait plus the reroute via pipelines, think about the Persian Gulf exports. They had gone from 40% of normal to 80% of normal, and then this re-escalation happened. And now we're back near those 40% of normal type of flows. So if you have a way to reactivate the Strait, the potential is certainly there because we've just seen it. The only difference is, I would say, for the first time around, you had a lot of oil sitting around, so it's easier to just move it. And now we're past that moment. So I would say the next layer of increasing flows is probably going to take a little bit longer to normalize.
We're already in August. We're counting down to winter, and that's when, people need their heating energy. Are you concerned that, as we inch towards the winter months, that we're not seeing a resolution in sight?
That's right. I think you touched on a very key point. When you think of natural gas, its main use is for heating purposes in the winter in the northern hemisphere. So if you think of Europe, if you think of Northeast Asia, that's when you need it for people to survive the winter. When you think of diesel or heating oil, a lot of that also has stronger demand in the winter for heating purposes. So I would say for those two products in particular, that's the main upside that we're worried about, especially on the natural gas side.
Pipelines are being constructed as we speak, but they're not going to be in service till maybe 1 or 2 years down the road. In the meantime, what happens? Do we see more volatility in terms of pricing? What are you anticipating, and what will countries be doing?
In the meantime, I think the market remains completely vulnerable to the Strait being blocked or having flows interrupted. We might not see a lengthy interruption, but we might see an occasional slowdown in the flows, where I think we have yet to understand how that's going to work, how that flow is going to work, but the vulnerability is there.
So in terms of pricing, what are we anticipating? I mean, we've seen how, oil prices have been reacting to headlines, basically.
Exactly right. So I'd say our base case is that you would have production from the Persian Gulf normalizing, say, by early Q4. If that were to happen, we could have Brent crude oil prices averaging Q4 at about $80 a barrel. We could have next year, that would be our base case, averaging about $70 a barrel. But to your point, if you have a headline suggesting, oh, maybe here we go again, and you can have another interruption of flow, then I think that's the risk that we have. The other thing that we need to track is how much production we see once this is over and done. So, for example, we've had high prices for so long that the U.S. is investing more in production. We're going to have more production from the Americas. So what if Saudi and the UAE, for example, can increase production a little bit more than what we expect? So you can also come out of this into 27 into an environment that might be a little softer than what we expect today. So I think there is a range of outcomes here. The biggest risk that we see is if we don't have a sustainable resolution, and maybe we have to go through next year still ramping up slowly this flow through the Strait. In that case, we could see prices well over $100 a barrel.
Is that the worst case? I mean, you talk about the base case. Is $100 a barrel the worst case scenario?
Yeah, the worst case scenario that we're working with at the moment is, let's say, if we only have a gradual improvement over the course of next year, we would be looking at $120 a barrel in Q4 this year, and next year could average around $100 a barrel.
Part of the reason why oil prices have remained pretty much within this range is because of China, right? China's demand has deteriorated. It's tapped its own inventories. Do you see China perhaps tapping the market again and perhaps driving prices higher?
Yeah, it's been remarkable to see. China has lent a lot of flexibility to the system, and a lot more than what we and the market expected, to be honest.
Why is that so?
So we think that it's a couple of things. One, China has invested over the recent years in two ways of increasing its own flexibility. One is the increase in the share of EVs in the automotive sector. So if you have an issue with gasoline, guess what? We can sell you an EV so that you can continue to move around and you don't have to worry about the gasoline price. In fact, once the war started, we saw the share of EV in total automotive sales in China going from above 50% to above 60%. That was extraordinary to see. That's one thing. The other strategy that China has implemented is to build strategic reserves, and China can be very opportunistic about that, meaning whenever oil prices are low, as they were last year, they can accelerate that pace of inventory build. They did that so that now, when we were facing this disruption, China was able to do both things: destock their inventories and at the same time continue to move people around with EVs instead of ICE cars.
I want to touch on another commodity that's making news, and that's iron ore, lowest level in a year, and that's to do with trader concerns as well as the demand outlook. What's your take on where iron ore prices are right now? Do you see a reversal anytime soon?
Well, to be honest, we had been expecting this pressure on prices for a long time, and it took a while to come. But when we think about what's behind iron ore demand, and a lot of it is still your steel production, your construction sector. And in China, that's really something that has changed more structurally, that has weakened structurally. For a while, steel exports were able to hold up iron ore prices a little bit more, but I think there is a structural issue there. It'll be difficult to sustain iron ore prices very elevated if that whole construction sector is on the weaker side.
So what would be the catalyst for iron ore prices in the next 12, 24 months?
So usually when that happens, it comes from some type of trade dispute. So, for example, we had that a few months ago with a company trying to sell to China and not allowed. So you had iron ore availability, but it was not allowed to enter the market. So when you have a type of trade dispute that can curtail supply that way from the market, this is the type of trigger that can cause prices to rise. But it's not fundamentally driven as in a long-term trend. I think the long-term trend suggests that we just don't have a strong demand growth path for iron ore.
And Samantha, we have to talk about gold. Quite fascinating amidst the Iran war, now at about 4,000. I'm just wondering, what's your take on it? How much volatility will we see in the price of gold?
Absolutely. So with gold, we have a structural view that still relies on central bank buying. So since the freezing of the Russian assets back in 22, we saw a shift in behavior of EM central bank buying with a step up in buying, because if it happened with Russia, it can happen to you. So it's more of a precautionary measure to diversify your reserves as a central bank. We think that this trend is very much alive. We see it in the data, and we think this is going to be a slow grind up, supporting gold prices still for at least another couple of years.
So how much upside for gold prices?
We expect the gold prices at $4,900 at the end of this year. So just under $1,000 of upside between now and the end of the year. Now, what can go against it, right? And I think it's still fair to be tactically cautious with gold, because when you have, let's say, a re-escalation of the war like what we had a few weeks ago, this can create a fear that the U.S. will hike rates. We just had a Fed meeting saying, no, we're not going to do it right now. But you're vulnerable to that type of fluctuation. And every time there is a fear that rates are going to be higher, this can increase the opportunity cost of holding gold. So you tend to see investors reducing their position in gold. So tactically, we're not totally out of the woods yet. I would say the environment is a little bit better in terms of support for gold right now after the Fed meeting. But it's something that can change with a headline. But the structural support is very much there in our view, and not just this year. We think still at least a couple of years to go.
And finally, your conviction call. What's the one bet in the commodity space for the next 12, 24 months?
Yeah, so I'd mention a couple of things. I'd say on the oil side, as I mentioned before, diesel, I think, is the oil product that is most vulnerable right now, not just because you have your seasonal demand strength ahead just in the winter, but on the supply side. And to your point in the beginning, it's not just the Iran war, it's what's happening to the Russian refineries as well. And Russia is usually a pretty big exporter of diesel, and now they have restricted it. So we are recommending a long diesel time spread, so going long the December contract of this year and short the March contract of next year, so a spread trade. And on the natural gas side, the sort of controversial call that we have is that after this crisis is over, this is a market in oversupply. So we look at the forward end of the curve, the back end of the curve, and it's overpriced. So we have been recommending a short for summer 2028 European natural gas TTF.
And we'll be on the lookout. Samantha, thank you. Samantha Dart, co-head of Global Commodities Research at Goldman Sachs. Now, still ahead, China's AI price war heats up again with DeepSeek unveiling a cheaper and more powerful model as competition intensifies across the sector. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. The AI race in China is heating up with several new releases in recent days, including from Alibaba and DeepSeek. For more, let's bring in our China correspondent, Min Lo in Hong Kong. And Min, tell us more about the new AI models that were released and how do they rank in terms of performance?
Yes, hot on the heels of the Kimi K3. Just this morning, Alibaba releasing a new model, 2.4 trillion parameters. It is the second largest open-weighted model in China so far, just behind Kimi K3. And according to Alibaba, it trails just behind Anthropic on certain benchmarks on the Arena leaderboard. And it even beats the Kimi K3 on certain benchmarks as well. And then you have DeepSeek over the weekend also releasing an upgraded model, the Flash V4, and that also boasts very strong performance, also still behind the Kimi K3, which is largely seen as the market leader here, but it edges out Alibaba's Qwen, but that is before today's new model release. So we were getting those ranking from artificial analysis, and because the Alibaba's new model was just out today, it's not part of that ranking just yet, but certainly you can see the intense competition among these AI model creators. And when it comes to pricing as well, that price war heating up as DeepSeek cuts the prices of its input and output tokens for the new model by up to 50%. And it's already, before that price cut, already the cheapest models out there in China so far. So certainly giving it more of an edge when it comes to market adoption.
And it's not just Alibaba. Minimax, ByteDance also released a new video generation model.
Yes, both of them releasing their own new video generation model, also within hours of each other. So it's the C-Dance, which we're very familiar with. It's very well known in China. There's an upgraded version of that. And also Minimax releasing the H3. Now, the H3 is boasting more natural and coherent visuals, and the C-Dance touting better editing capabilities. And again, doing very well in the rankings. If you look at the Minimax, it is number one when it comes to editing capabilities on some leaderboards, and also in the top 3 when it comes to text to videos or image to videos. So very strong performance. And again, on pricing, Minimax H3 is the one that stands out, priced at just about half of some of its peers, particularly when it comes to even high-res videos like 2K videos. So that also gives it an advantage. But of course, the big question is, again, monetization, because our own Robert Lee from Bloomberg Intelligence is once again warning that he doesn't see this sector becoming profitable in the next 3 years because of how intense that price competition is. So unless at some point these companies start to have more rational pricing, we might still be deep in the red.
That's right. Competition intensifying. Min, thank you. Bloomberg's China correspondent Min Lo for us in Hong Kong. Still to come, we'll get the business outlook with Daiichi Sankyo's president and CEO Hiroyuki Okuzawa after they boosted their latest operating income guidance but missed the street's estimates. That exclusive coming right up. This is Bloomberg. Welcome back. You're watching Inside. Here's a quick look at the yen as Japan and the US warned of further coordinated action in FX markets. That's after confirming their first joint intervention in 15 years to lift the Japanese currency from a near 4-decade low. President Trump, for his part, earlier said the joint intervention was a signal of Washington's friendship with Tokyo.
We have a good relationship with Japan. We're very strong, very, very strong financially. They have a weakening yen, and they wanted a little bit of help, and we're always there for Japan. Japan's been very good to us, with the exception, of course, of Pearl Harbor.
Mr. President,
they were not good.
What is the U.S. getting out of that arrangement?
Financial benefit. Financial benefit. And it's also good for the world economy.
For more, let's bring in Bloomberg Intelligence Chief Emerging Markets FX Strategist Stephen Chu. Stephen, will this joint intervention work?
Hello, Haas. I mean, it will work better than a solo effort, as we have seen in April and then last Thursday. And the best reference is when we look at 15 years ago, that was a coordinated effort between the G7 economies. Back then, they had to weaken the yen. And the impact lasts for 3 weeks. It's still temporary, but at least it's better than when we are talking about days. So this time we had a US-Japan coordinated effort, and hopefully the impact, the support to the yen can last longer than last week. And one final point is, in 2011, back then, the yen weakened by over 10% against the dollar. So this time, so far, we had about 5% rally in the yen. So there could be more room to go for the yen versus the dollar.
Well, bear in mind that they have said more intervention could come. What's the implication for dollar yen and other Asian currencies here?
Right. So at least for now, the traders, they are warned. They would not open a new carry trade shorting the yen, and they may think about unwinding the carry trade. So with that in mind, that will support the yen against the dollar briefly, at least. That will support other emerging market Asian currencies, especially the Chinese yuan. One reason why Chinese authorities have been reluctant to let the yuan rally further in the recent weeks or recent months is because the yuan has been so strong against the yen. And the yuan basket was so strong because of a weak yen. So now, if we see a huge rally in the yen against the yuan, then that could create some room for China to allow the yuan to appreciate against the dollar. So after weeks of a very narrow trading range in the yuan, we could see some excitement.
Well, we await that excitement. Stephen, I'm just wondering, how strong can the yen actually be? The murmurings out there, we're looking at 155. Is that what you're looking at as well?
For now, if you ask me the floor for dollar yen, I would say in the near term over the next month or so would be near 150. As I've just mentioned, last time, 2011, we're talking about a 10% move in the yen. So this time, there could be more room. But however, what we learned from 2011 is eventually the yen move because of the intervention got unwinded. And the yen didn't weaken back then until Abenomics kicked in. So this time, if we want the yen rally to sustain, we need the Fed and, of course, the BOJ to do something to meaningfully narrow the US and Japan gaps. Back to you.
Well, let's see whether it is different this time round. Stephen, thank you. Bloomberg Intelligence Chief Emerging Markets FX Strategist Stephen Chu there for us. Let's discuss the impact of the yen's moves on businesses with Japan's second largest pharmaceutical company, Daiichi Sankyo. Its president and CEO, Hiroyuki Okuzawa, joins us exclusively from Tokyo. Okuzawa-san, thank you so much for your time. On the yen, what do you make of it? Because your company is among Japanese companies which have benefited from a weaker currency.
Thank you for having me. So with regard to the exchange rate, basically the weaker yen, a stronger dollar is an advantage for top-line growth. But on the other hand, Daiichi Sankyo is spending a lot of expenses such as clinical trials outside of Japan. So those expenses has a negative effect. So when it comes to the bottom line, the change of exchange rate is a neutral.
So there's no reason for you to review your numbers, so to speak. I mean, we did have the authorities, both from the US and Japan, saying they will do what it takes to support the currency. More intervention could come.
So we will be watching carefully how the exchange rate will develop. But in the coming 3 quarters from now onwards for the fiscal year 2026, we set the 155 yen to $1 US. So that is the very good rate for us to be trusting on our annual forecast.
So would 155 be the threshold for you? You're comfortable for the currency to be at that level, Okuzawa-san?
So, as I said, we are the neutral in terms of the bottom line. So, therefore, how the exchange rate will be changing would not affect to our business, basically.
The other challenging environment is actually the tariffs being imposed by the U.S. on drug producers. How are you assessing the possibility of that 100% tariff next year, 200% the following year? What's your take on it, and how are you positioning for it?
Yes, the numbers such as 100% or 200% tariff was reported, but my understanding is those high rate of tariff will be applicable for the generic medicines in the United States. So Daiichi Sankyo is the global innovative pharmaceutical industry company. So that means our innovative products would not have such a negative impact from the tariff at the moment. That's my understanding.
So tariff exclusion for Daiichi Sankyo, correct?
So our flagship product, like ENHERTU database, ADC product, antibody drug conjugate. And so far, what we have heard from United States administration is these ADC products will be exempted from the tariff. So that is a good news for us.
Okuzawa-san, we know that Daiichi Sankyo has a strong relationship with AstraZeneca, which is now, according to some reports, mulling a merger with Bristol Myers. What's your take on the news that we're hearing right now?
So I'm aware of those reports, but let me decline the comments. Just I would like to say our relationship between Daiichi Sankyo and AstraZeneca for our ADC products and HER2 database has been going very well. So therefore, whatever AstraZeneca would develop their future with any other company, I'm very much happy to collaborate continuously with AstraZeneca.
Might the merger reshape the relationship that Daiichi Sankyo has with AstraZeneca? Because that potential merger would produce one of the largest drug makers in the world.
I don't think the potential merger of AstraZeneca would have negative impact to our ongoing relationship, because both parties, Daiichi Sankyo and AstraZeneca, are so happy about the great success of our partnership for ENHERTU and that way. My conviction is AstraZeneca will continuously be trusting Daiichi Sankyo because these two partnered programs are very much important for them and for us.
If it is an important relationship, are you looking to expand that relationship?
It depends on the development program. So we have a lot of new pipelines, and depending on the size or market or technology, etc., we have always the option to develop together with a strong partner like AstraZeneca, or we develop by ourselves and commercialize the products by ourselves. Those are always the strategic options for us.
And Okuzawa-san, we know that in terms of cancer drugs, there is a huge race to produce the next new cancer drug. How do you stay competitive? How do you stay ahead of your rivals, especially those in China, which is scaling so quickly?
So we are aware that China is emerging as an innovation country because of the very much intensive the innovation creation by Chinese pharmaceutical companies. And I think this is a great opportunity for Daiichi Sankyo because the many Chinese companies are working in the ADCs, which is our great advantage because Daiichi Sankyo is the originator of our unique DXd ADC technology. And further, our discovery research team is working on the new generation ADC that would have the different payload, different technology. So therefore, we would like to explore any kind of opportunity to work with the emerging innovative Chinese companies.
What's crucial when it comes to Chinese drugs is that those oncology drugs produced by China are often launched at 30 to 70% discount. How do you defend the kind of premium pricing you have at Daiichi Sankyo?
So primarily the answer is our technology advantage. And based upon our DXd ADCs, the products like ENHERTU or DATROWAY have been delivering the fantastic clinical data. So these clinical data are always the base for the new indications with which we can deliver our innovative advantage to the patients. So therefore, whatever Chinese companies would bring their innovation in the future, Daiichi Sankyo is ready to fight against in terms of science and technology. And as far as we can deliver continuously the cutting-edge technology that could lead to the advancing the clinical data, that we can explore and we can secure our competitive position, I believe.
You talked earlier about possibly partnering with Chinese drug makers. Where are you with that? Are you in conversations? Can we expect a partnership in the next 12 to 24 months?
So let me decline the comment on that. But we are always looking for the opportunities to collaborate with the pharmaceutical companies in the United States, in Europe, and now also in China. We have a very strong business development team that is always looking for the opportunities for in-licensing and also the out-licensing. So in that sense, I'm very much looking forward to talking to the Chinese companies and discussing the potential collaboration for future.
Okuzawa-san, we thank you so much for your time today. Hiroyuki Okuzawa, President and CEO at Daiichi Sankyo. Let's do a check on the Indian markets. 2 minutes to the trading open, and we have pre-market suggesting a higher open right now. The Sensex up by about 1%. India, of course, has been benefiting from cracks in the AI trade. We've seen an 18% surge in India's tech stocks in particular. In terms of the INR, the Indian rupee 95.1525 is the level we're looking at right now. It is higher by about 0.3%. And still to come, our exclusive conversation with Prudential Chairman Douglas Flint on the opportunities he's still seeing in China after Beijing's crackdown on cross-border insurance sales. Stay with us. This is Bloomberg.
And of important measure in the bond market, which is break-even inflation. So sort of traders' expectation of inflation is at or below where it was, at least after 10 years when he became chairman. But certainly the reaction during the press conference was probably not one that was welcome.
The silence of Warsh was really quite deafening, and the financial markets, basically said thumbs down. I mean, the fact that the 30-year yield went up, the 10-year yield went up, and 2-year yields dropped really was a sign that, that there was a loss of credibility from that press conference.
Former Fed Vice Chair Richard Clarida and former New York Fed President Bill Dudley there. As scrutiny grows over Chairman Kevin Warsh's policy messaging. Let's get more on the macroeconomic outlook with my next guest, who is a renowned figure in the world of finance. Joining us exclusively, Douglas Flint, Chairman of Prudential, which provides life and health insurance and asset management services. He was previously Group Chair of HSBC and Chair of Aberdeen Group. Good to have you with us. It's been such a long time since our last conversation. I'm just wondering, how sensitive is Prudential's balance sheet to higher for longer?
Not particularly sensitive. I mean, we think about decades rather than quarters, so the excitement over sort of the signals that markets give from time to time in reaction to announcements is something you keep an eye on, but you are managing over a very long period of time in terms of the money that's been entrusted to you by insurance and investment management clients.
So no change to capital planning on the back of higher for longer, which many people didn't expect when we kicked off the year, or even like last year, for instance.
I think we've had so many signals that interest rates are going to stay low forever, they're going to stay high forever. I don't think anybody knows. There are so many uncertainties in terms of geopolitics, in terms of the trade flows between the West and the East, China and the United States. I think anyone who knows what's going to happen is incredibly talented and has a crystal ball that I'm not aware of. But I do think we're getting, when we look at the sources of inflation, they're very much in a very small segment of the market in terms of all the money that's going into AI. And then you've got the impact of the Iran situation, which is impacting hydrocarbons, impacting food because of fertilizer and all sorts of other things. And these things are hopefully temporary. Because we're going to hopefully see that situation end. We're hopefully going to see the investment boom in AI come to an end, and then see how that plays through. So I think, again, if you take a long-term view, you have to look at the underlying growth of the global economy, which is still positive, but still is going to be a great deal less than some of the excitement that people are projecting.
So still a challenging environment. How are you looking at capital deployment? How are you looking at investing in the next 12 to 24 months for the company?
Again, we think of it in decades, not in...
So where in Asia do you think you'll be putting your money?
Well, we're putting money in the markets and where we're collecting insurance funds, because we invest in the markets that our customers are in, because that's out of those funds we have to pay them the returns that they expect on their policies. So we'll be...
So it's still big on China, still big on...
Still, I mean, I think the big trends are power generation, climate change, energy transition, manufacturing capacity being built up to support a more technological advanced world. All of these things are trends that are being invested in. Where people choose to site their particular plants, their data centers or whatever, will depend on access to power, access to renewable energy, and so on and so forth. So it's very difficult to say you're going to choose this country or that country to invest the money, but you are investing thematically across the region.
But still, Prudential is doubling down on China. I mean, how do you take into account a slowing economy and also a very interventionist government when it comes to regulations?
I think all governments are becoming more interventionist. I mean, it's very clear that the Chinese government has an ambition to boost domestic consumption, and indeed the world is waiting for it, hoping for it, encouraging it to boost domestic consumption, to move away from an economy that's dominated by exports. And I think China recognizes it needs to do something to boost domestic consumption to get a more balanced economy, because the pressure it's putting on its trading partners in continually increasing its exports is problematic. On the other hand, it has an extraordinary position in the technologies of tomorrow, whether it's electric vehicles, data centers, power generation, and so on, robotics. It's incredible to see this scale advantage from just having that size of an economy.
So no change in terms of your appetite for China, correct?
No.
And in terms of India, why isn't Prudential more aggressive in that market, given the potential of growth?
Well, I think we've made a very strong statement in terms of agreeing to invest in Bharti, effectively create an insurance operation that we have a majority control over. Because while we have a very successful partnership with ICICI Bank, we are very much a minority shareholder, and therefore we want something that we can have more direct influence in. So we're investing the thick end of $500,000 in investing in that stake, and hopefully we'll get the necessary permissions later on this year to enable us to start to grow that business. But over the long term, but that we are talking now in decades, over the long term, you can't ignore it, is probably the second market to China in terms of the need for broader insurance products.
So Douglas, I'm just going to break some headline here, because on the back of that coordinated intervention between the US and Japan, we're seeing Japan's 5-year yield rising 5 basis points to 2.075, which is the highest since its 2000 debut. So we're seeing reaction in the market on the back of the coordinated intervention. What's your take on the Japanese market?
It's been an enigma for a while, actually. I mean, I can see why there would be concerns over the strength of the yen, and it's good to see America and Japan working together on that. But it's been a very hot market for a long time now, but we're not very big in Japan.
And I just want to follow up on India, because prior to that breaking line, following the Bharti Life investment, regulators are now expected to require Prudential to reduce its shareholding to under 10% from the current 22%. Where are you with that? What's your take on that?
Well, we're waiting to see what the regulators demand. We anticipated that and disclosed that when we announced the deal. So we will seek to do that in a proportionate way in conjunction with our partner to make sure that we don't do anything disruptive to the market. But I think we signaled at the time that having made the investment in Bharti, we would progressively, in line with regulatory guidance and in conjunction with our partner, take down our stake in our joint venture.
As we said earlier, it is a challenging environment for a lot of businesses. What's the growth strategy for Prudential going forward?
The growth strategy is very simple, which is to address the underinsured need across Asia, and to some extent Africa, but predominantly in Asia. It's a very underinsured population, and as demographics of the world, but the demographic...
Is there a risk of being too concentrated on Asia and the need to diversify?
I think to be concentrated on one of the most attractive, fastest growing markets with the least degree of penetration, if you had to be concentrated, that's where you'd want to be concentrated. It is a staggering number of people in Asia when you add up all the countries that we're in, and therefore as there is an emerging middle class, an emerging need for greater health protection, investment, accumulation to deal with retirement, and in a world where the birth rate is declining in many, many parts of the world, and therefore the younger generations are going to have to understand they're going to have to take more responsibility for their future planning in terms of asset accumulation, health, and other kind of protection, because there's also going to be a burden on the public systems for an aged population.
So Douglas, we have to leave it there, but do come back. Thank you so much for your time.
If invited. Thank you.
Douglas Flint, Chairman of Prudential. And when we have breaking news, we're busy on breaking news. Malaysia's top bank is set to near buying Asia's stake in Etica. Malaysia's top bank is said to be nearing buying a stake in Attica. Will bring you the latest when they come around. That is it for Insight. In the meantime, Horizons Middle East and Africa is up next. Keep it here with us. This is Bloomberg.